Is choosing the lowest buy-to-let mortgage rate really saving you money, or could it secretly cost you thousands extra? In this video, I'm going to show you exactly what you need to know about buy-to-let mortgage rates. No hype, just practical long-term strategies to protect your investment. Fixed versus variable rates. When it comes to buy-to-let mortgages, you'll face the big choice between fixed or variable rates. A fixed rate gives you peace of mind with consistent monthly payments, protecting you from interest rate rises. On the other hand, a variable rate could offer savings if interest rates fall, but it comes with uncertainty. The key is deciding what's more important, stability or potential savings and risk. Loan-to-value impact on rates. Your mortgage rate significantly depends on your deposit size, known as loan-to-value or LTV. A lower LTV generally means better interest rates. For example, a 60% LTV mortgage typically has more attractive rate than a 75% or 80% LTV mortgage. If you can increase your deposit up front, enjoy better rates and longer-term savings. Product fees and true cost of low rates. Some mortgage deals feature very low interest rates, but often come with higher product fees. This isn't the lender playing games, it's a strategy to meet regulatory requirements, specifically the Prudential Regulation Authority's Interest Cover Ratio, or ICR. Low interest rates help landlords pass affordability tests in a challenging rental environment, but lenders still have costs. They borrow funds from savers or the capital markets, meaning they can't lend cheaply without covering those costs. The solution? High product fees, which effectively is front-loaded interest. Always check the total cost fees plus the rates, not just the headline interest rate. Initial rate periods and reversion rates. Many attractive mortgage rates are temporary, typically 2, 3 or 5 years. But watch out, after this introductory period, rates often jump dramatically to a lender's higher standard variable rate, known as an SVR. Always plan ahead. Mark your calendar and talk to your broker 6 months before the initial rate ends, so you're never caught paying more than necessary. This is something that I do automatically. Mortgage term and its impact on cost. The length of the mortgage term can significantly affect your overall costs. Extending the term makes the monthly payments more manageable, but it increases the total amount of interest paid. Shortening the term means higher monthly payments, but it saves thousands in interest. Always balance affordability today with the long-term cost efficiency. Interest-only versus repayment mortgages. Interest-only mortgages are popular with landlords because they offer lower monthly payments and better cash flow. But remember, you'll still owe the original mortgage amount at the end. Also important, since interest is typically calculated daily, interest-only mortgages result in higher total interest costs over the mortgage term compared to repayment mortgages, where the loan amount steadily reduces each month. A repayment mortgage saves interest over time, but negatively affects the immediate cash flow. Consider your long-term plans carefully when deciding. Reviewing and remortgaging your mortgage. One of the smartest things landlords can do is regularly review their mortgage rates. Aim to review your mortgage around 6 months before the fixed or discount rate ends. Staying proactive and remortgaging regularly ensures you always have a competitive rate, saving potentially thousands of pounds over time. Understanding APRC. APRC, also known as annual percentage rate of charge, is designed to show the true cost of your mortgage, including fees over the entire mortgage term. But remember, APRC assumes you keep the mortgage for the full term, which landlords typically don't. It's a useful guide, but always speak to your broker to see what the real-world costs look like for your actual investment strategy. Early repayment charges and alternative finance options. Early repayment charges can be costly if you repay or refinance early, often thousands of pounds. But there are alternatives if you need to raise capital without incurring ERCs. You might consider secured loans, also known as second charge mortgages. These allow you to borrow extra funds without disturbing your existing mortgage deal. Perfect for releasing equity quickly. And then you've got bridging loans, short-term financing useful for auction purchases or refurbishments, ideal if speed is crucial without disturbing existing low-rate mortgages. Always consider these options carefully with a broker to avoid any unnecessary early repayment charges. Mortgage broker versus going direct to the lender. Should you go directly to your lender or use a mortgage broker? While dealing with your bank seems straightforward, you're limited to only their products. A specialist broker has access to the broader market, including exclusive lender products that aren't available on the high street. A good broker doesn't just save you money, they save you time, hassle, and help you clearly understand your best options. The buy-to-let mortgage landscape can feel complicated, but making the right choices means protecting your profits and building your property business securely. If you want clarity, personalised advice, or simply to ensure you're getting the most from your mortgage strategy, I'm here to help. Reach out to me directly and let's make sure you're on the best possible path to maximise your property investments. Thank you for watching, and I'll see you next week.